Welcome to the Market Desk. In the stock market, the terms bull and bear are used to describe market trends and the attitudes of investors. A bull market refers to a market where prices are rising or expected to rise. Investors who are bullish or optimistic believe that prices will continue to go up, and they may buy more stocks in order to take advantage of these rising prices. This can create a self-fulfilling prophecy, as more buying can drive prices even higher. Bull markets are generally characterized by optimism, strong economic growth, and low unemployment. On the other hand, a bear market refers to a market where prices are falling or expected to fall. Investors who are bearish or pessimistic believe that prices will continue to go down, and they may sell their stocks in order to avoid losing money. This can also create a self-fulfilling prophecy, as more selling can drive prices even lower. Bear markets are generally characterized by pessimism, economic downturns, and high unemployment. It's important to note that bull and bear markets can happen in any type of investment, not just stocks. For example, there can be a bull market in real estate, where property prices are rising, or a bear market in bonds, where bond prices are falling. In simple language, a bull market is when stock prices are generally increasing and investors are optimistic about the future. While a bear market is when stock prices are generally decreasing and investors are pessimistic about the future. It's also important to note that the terms bull and bear are also used to refer to specific strategies employed by investors. A bull strategy usually refers to a strategy of buying low and selling high, in the hopes of making a profit from rising prices. A bear strategy, on the other hand, usually refers to a strategy of short selling or selling an asset that you do not own in the hopes of buying it back at a lower price later. It's important for investors to understand the difference between bull and bear markets, and to have a clear investment strategy in place. In a bull market, investors may want to focus on buying stocks that have the potential to increase in value. While in a bear market, they may want to focus on preserving their capital by selling stocks that are likely to decrease in value. Bear markets tend to be more difficult for investors as they can be characterized by high volatility and uncertainty. But even in a bear market, there are opportunities for investors who are able to identify and take advantage of undervalued assets. It's also important for investors to have a well-diversified portfolio to mitigate risk in case of a bear market. In conclusion, the terms bull and bear are used in the stock market to describe market trends and the attitudes of investors. A bull market is a market where prices are rising and investors are optimistic, while a bear market is a market where prices are falling and investors are pessimistic. Investors should have a clear investment strategy in place and be aware of the different opportunities and risks associated with bull and bear markets. Thank you for watching the Market Desk YouTube channel. Subscribe to see more videos like this.